You are listening to Mining Stock Education.
This reminds me of a discussion I had years ago with Eric Sprott. And I was saying, in natural resources, Eric, my belief is that if you minimize your losses, your wins take care of themselves. And he started laughing and he says, Rick, I believe that if you have some really good wins, the losses don't matter. Turns out he was right and I was wrong.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Rick Rule, CEO of Rule Investment Media. In our conversation today, you're going to hear Rick's views on portfolio allocation, optionality in the gold market, luck, the Rule Investment Symposium, and much more. Rick, it's great to have you. I wanted to start the conversation off with portfolio allocation. And I wondered how you choose the appropriate allocation for any company in your portfolio.
That's a really great question, Brian. And I've come to learn late in life that there isn't an answer. There's not a one-size-fits-all answer. As you know, Brian, I've graded for free literally tens of thousands of portfolios over the last 30 years. And I've learned that most investors would do a lot better if they analyzed themselves before they started buying stock. What are your goals? What is your risk tolerance? What is your time preference? How much work are you willing to do? I would also tell you, Brian, that most investors and speculators mischaracterize themselves. If you visit with them individually, and I've done that with thousands of them over the phone, most people describe themselves as conservative investors, when in truth they're wild-ass speculators. There's no harm in that. It's just that you need to acknowledge it. When I make jokes about speculators at my conference, my wife always cautions me publicly that all of the money that I now invest conservatively, I made speculating aggressively. So it's all good. I will tell you this, though. I'm going to get around to answering your question, sort of, eventually. In natural resource bull markets, and make no mistake, at least in precious metals, we're in one now. There is so much money to be made just in the beta, which is to say, the amount by which the sector outperforms the broad market, that most investors would be well advised to take less risk, buy higher quality companies, and not do the work that's required to be a good speculator. The audience that listens to Mining Stock Education begins to self-select. That part of your audience which is willing to do the work to understand how to speculate, and separately is willing to endure volatility, and thirdly is willing to ignore their own time preference and understand that money in investing and speculating is really made by compounding, which takes time. Those people can and probably should speculate. But the truth is, I've been asked one-size-fits-all questions about portfolio management for almost 50 years now. And I've come to conclude that if there's 8.2 billion people on Earth, there's 8.2 billion answers to that question.
Yeah, absolutely. Absolutely. Yes. So, okay, how about this question then? For you personally, is there a maximum you would allocate to one company?
No. Buffett famously says, put all your eggs in one basket and watch that basket. I haven't found a company ever in my life that was good enough to put all of my eggs in. Well, I take that back. When I was 19 and I had almost no money, I was fortunate enough to put all my eggs in one basket, and that basket performed extraordinarily well. Understand that there weren't very many eggs to put in that basket. And that I was a young man who was too poor to do portfolio diversification. I was, however, a young man that had access to the geology professors at the University of British Columbia. And mercifully, I got steered in the right direction. It is rare for me now to have more than 10% of my portfolio in one stock. Although I do have a concentration in Sprott Inc., a company that I sold my business to. I have a separate concentration in a private insurance business, which I own and run. And I'm developing a smaller portfolio concentration in the company Battle Bank, depicted on the shirt I wear.
Well, let's use me as an example. I've been in the market for 9 years now, doing this thing on my own. One of the things that I've been sort of struggling with in terms of allocation is how much to put in what I would call like the contrarian part of my portfolio. You've got, gold, silver, uranium are running. There's definitely making some money in that portion of the portfolio. Where the contrarian investments, well, I understand what being contrarian is, and it's not easy, as you're kind of alluding to, the patience that's needed. But I wondered, in terms of seeking alpha, what is there a certain percentage that you would look at having that's not performing versus performing?
I've watched you for a long time now, Brian, and I suspect that you are the right candidate to be an aggressive, long-term contrarian speculator. You, early in your career, enjoyed pretty spectacular success, and then the market came and clawed a lot of it back. So you've already experienced the thrill of victory and the agony of defeat, which means that you are unlikely to get spooked out of something. You have a young man's impatience, but that's okay. You're aging. I think that you have probably been prudent enough to scrape enough money out of the process that you have security for yourself and your family. And I think also in mining stock education, you probably have a business that can provide for your basic needs. In that case, if you're after what I was after at your age, which is to say true wealth, you need to focus on the long term. Money's made by compounding. I don't need to make more money, but I want to. And the consequence of that is that I have rather large investments in positions that I don't think will pay me much over the next 5 years, but where I think it is more likely than not that I will enjoy 10-fold or 15-fold or 20-fold returns. This reminds me of a discussion I had years ago with Eric Sprott. And I was saying, in natural resources, Eric, my belief is that if you minimize your losses, your wins take care of themselves. And he started laughing and he says, Rick, I believe that if you have some really good wins, the losses don't matter. Turns out he was right and I was wrong, but we have different ways up the same hill. But as an example, I have large positions in junior companies, in out-of-favor commodities where their deposits are potentially tier one deposits, and usually in countries that people don't like. So in terms of sentiment and momentum, these things have everything possible lined up against them. And it's been precisely these techniques that are likely responsible for half my net worth. Despite the fact that I've probably traded in and out of 300 or 400 stocks, when I look back at what made a difference to my net worth over time, there were probably 10 or 15 decisions out of 300 or 400 starts. Were I advising Brian Lenny, I would say take an amount of money that you could lose half of without it changing your decision as to what to feed your family for breakfast. And separately, an amount of money that the volatility that you will experience doesn't matter to you. And ignore the markets. Buy in anticipation of 10-fold returns or 15-fold returns or 20-fold returns. When I think back to my experience in Paladin, which was my single biggest hit in my career, it took me 6 years to be right. Including enduring a 90% decline in the share price. 90% decline in the share price. But that stock, my initial investment was at 10 cents, mercifully with a full warrant. The stock fell from 10 cents to a penny. I missed the penny trade, but I didn't miss the 1.5 cent trade. And within 6 years, that stock went to $10. So let's leave out the 1.5 cent purchase. Let's just do entry on. A move from 10 cents to $10 if you have the checkbook and the cojones to take a big position, changes the rest of your life financially. And I think you're probably in a position, and I think you probably now have the knowledge and the willingness to work that you need to do that. No, that's not right. You don't need to do that. But I suspect, given the Brian Lenny I know and what you'd like to accomplish for yourself and your family, that you ought to do that.
Right. Are you familiar with the fable of the scorpion and the frog?
I am.
And so I wanted to ask you this with reference to junior resource company management teams. Is a scorpion always a scorpion?
Yeah, probably. But you don't have to hang out with scorpions.
Right.
Incumbent on the frog to decide who he lets on his back. I have found that all of the money that you can count on making, you make with good people. I've been fortunate in my life to, I met Adolf Lundin when I was 21. That meant that I met Lucas Lundin and Ian Lundin before they were out of high school. I met Ross Beatty and Bob Dickinson in university. Ross Beatty introduced me to Bob Quartermain. A really, truly virtuous circle. And I think we've discussed in past interviews Pareto's Law. If not, we can do that again. But the truth is that probably 1% of the junior mining entrepreneurs generate 40 or 50% of the value made in the sector. There's a lot to be said for doing less, just hanging out with the best of the best, and not even answering phone calls from the rest. It isn't as much fun. You miss, as an example, a Brian Dalton, a young, toiling geologist who you can finance at 5 cents, which I was able to do with Altius. You do miss those occasional sprouting superstars, but you miss an awful lot of aggravation too.
Well, Rick, I bring it up because it was a good learning experience for myself. Like, some of these groups of companies in the business, they have some success, and then the companies that are associated with them or who they lend their name to sort of gain this notoriety. And so I looked at the company and I thought, you know what? There's some things I didn't like about it, but I thought there was some good people involved and they had lent their name, and I thought for a reason. And it turns out I was wrong. And I look at it back and I listen to what you're saying, and it's like, I probably could have been more precise in looking at the person's actual involvement with the company and surmising how they would support it, as in terms of financing and, the marketing side of things.
I've known some tier one guys who will take a large, cheap position in a proposition where they believe can be promoted, and turn $100,000 into $3 or $4 million. And as you suggest, it's very important, I think, if you're buying the stock because of the participation of that person, that you determine for yourself what that participation will be. I have the good fortune to, when I see a Ross Beatty buy something, call him up and say, hey, what are you thinking? What is this? Is this passive? Or are you going to lean into this thing? And usually the really good people will tell you, I kind of like these people. I really like this project. I remember when Bob Quartermain got involved with Dakota Territorial the first time before he went on the board and stuff like that. I said, what are you thinking? And he said, I'm thinking that poking around one of the largest historic gold mining districts in the United States is a really good idea, And, I said, would you get involved in it? He said, well, I'd prefer not to. I've done 3 companies. I'd like to rest on my laurels. But the truth is, when the drill holes started coming in, and this happens to good guys, they just can't resist. They can't resist. They look at a task that's happening in a company where they know they could do it better. And they can't resist getting in and doing it better. Sort of like me with a bank. You see a need, and you have to fulfill it. You just have no choice.
The conflict in the Middle East seems to get even more serious. The commentary I've read over the last couple of days is pretty troubling. With that conflict, it would seem to me the first thing that jumps out is obviously energy. The Middle East is one of the biggest contributors of oil worldwide, and this whole Strait of Hormuz is an interesting topic if that were to get restricted. How do you see, in terms of its effect on the resource market, is it purely energy that this sort of conflict would affect?
No. War is bad. It's bad for humanity. It adds uncertainty, and the markets hate uncertainty. It's also economically destructive. So in every sense, to the extent that this conflict grows and uncertainty grows, it will be bad for financial markets, and it will be bad for the global economy. I think that if the conflict isn't long-term, that the damage to the economy will more than offset the hiatus in oil production if the Straits of Hormuz don't close. You'll notice that before this conflict, oil production was cresting. It wasn't increasing. In fact, in some areas, export crude was decreasing, but the price of oil was going down too. That tells me that the economic slowdown that we're facing, both in the United States and globally, is probably more proximal than most people think. And I would suspect that if the conflict ends, that crude oil prices would fall to the $60 range fairly closely. If, coincidentally, the conflict between Russia and Ukraine ended, by the way, I'm not forecasting that. That's not what I do. I think that you'd see the crude oil price fall for a while further. But that's a trap. It's a trap because on a global basis, we have been, until 4 or 5 weeks ago, underinvesting in sustaining capital investments in the oil and gas business by $1.5 billion a day. And that impacts our ability to produce 2, 3, 4 years out. I say until 2 or 3 weeks ago because I suspect that the Iranian investments in sustaining capital investments right now in their oil business are nil. They, like the Russians, have another need for the money. And I would be very surprised if the current deficit for sustaining capital investments on a global basis isn't $2 billion a day right now.
Right.
And that will have an impact in the out years.
Right. Would you say that the situation with copper is similar to oil?
I think the softness in the near term quote that we saw until 6 weeks ago, probably, and I'm no economist, but probably had to do with the fact that while everybody understands that there's going to be a copper supply deficit in 4 or 5 years, current demand for copper is weak. Maybe as a consequence of U.S. tariffs. There's no doubt that the West Coast ports in the United States are looking for work. There's not a whole bunch of stuff coming from China to Walmart. And less U.S. demand means less fabrication demand worldwide. I think it's probably a reflection of the fact that the broad economy is worse than we think it is.
Right. Some say luck is when preparation meets opportunity, and some have told me that it doesn't exist. What's your stance on luck?
I've been very lucky. I think maybe I've made my own luck in some senses. But think about a young man trying to put his way through university. That's me, by the way. Owning a bar in Vancouver through an odd set of circumstances. Being introduced to Adolf Lundin. That was lucky. But that luck had to do with the fact that I had come to own a bar. And I was recognized by some people as a very hardworking, very interested young man. So I think I contributed to my own luck. I've been thinking about this a lot, Brian. The mentors that I managed to accumulate between the ages of 20 and 30, Seymour Schulich, Ned Goodman, Adolf Lundin, Peter Brown, truly an extraordinary group. I was very lucky. Part of that luck I created. I was a young American boy interested in natural resources and less interested in Vietnam. So I emigrated to Canada. Was that luck? Was that preparation? Probably lots of both. I can tell you this, a lot of my success was due to making myself useful to other people. All my failures, unfortunately, I was the author of. So all of the bad luck that I suffered, there were reasons for which I can identify.
Optionality. If you go back a year and a half, 2 years, there was definitely such a thing as optionality in the gold market. You know, these large, high capex projects that needed basically the prices we see today to work. My question for you is now the time to buy optionality, and maybe what is optionality today?
You have to pay too much for optionality today. You know, I was a real proponent of optionality in 1989, 1990, because optionality was free. It was truly free. When we set up and financed Silver Standard, Pan American Silver, Vista Gold, Lumina Copper, you could buy deposits that had $50 or $60 million spent on them for exploration and had identified large resources that were out of the money during a period of time when the commodity prices were less than the global cost of production. And you knew that the commodity prices had to rise to the global cost of production, or else the commodity would be unavailable. You could buy those deposits so cheaply. And the market caps, we, partly me, managed to sell the concept of optionality through the newsletter community, through Jim Blanchard, through Doug Casey, through Adrian Day, Larry Abraham, the usual suspects. And we developed a constituency for optionality that allowed us to continue to fund those companies during the bad years. But here's an example. Silver Standard, which over time bought 1 billion ounces of silver in the ground, had a starting market cap of $2.2 million. The great optionality companies now, Rudy Frank's company as an example, has a market cap of $1 billion. I'm not saying that you don't play that game. What I'm trying to say that in nightclub parlance, the cover charge is very, very high now, which by itself reduces the optionality. If you tried to recreate Lumina Copper today, Ross Beatty was able to go to BHP and Rio, the biggest mining companies in the world, and find projects that were uneconomic at 80-cent copper, knowing that the copper price had to go to $2 in order for the world to have any copper. And he was able to buy those projects just unbelievably cheaply. And the majors were spending no money on them because their net present value calculation went out 5 years. Ross, figuring that the best place to look for copper was in the headframe, around the headframe of a copper mine, was able to sell the optionality thesis to investors and raise enough money both to acquire the deposits and to begin to do exploration. When the market changed, Ross was able to sell those same projects back to different multinational mining companies, and he made all of us an absolute fortune. The success that we enjoyed in optionality in the period 1989 to 1996 meant that a whole bunch of people adopted the optionality thesis. And the cover charge that we enjoyed, the ability to begin the process very cheaply and buy these assets from major multinational mining companies very cheaply, that's all gone. You can't do it. So does it still work? Yes. Does it work as well as it used to? Not even close.
Recently, and it's been a while since I've been pitched this idea, but I was in Vancouver in May, and I got pitched two different stories where they were talking about going to production and funding exploration and expansion through that production. And the one guy referenced the Aussies as being really good at running this business model, and they had this and this connection. I was wondering your stance on that sort of business model. You know, the critical mass to start or put something into production today is a lot less than it was a year ago. And I think the idea sounds interesting, but to me, it seems like a heck of a lot of risk.
It's all about who's doing it.
Okay.
There are some teams in Australia, the team around Emerald Resources today, who were the guys behind Regis Resources. These guys are superb at getting a 500,000 ounce deposit, building it, operating it well, attracting a premium market cap relative to the net present value of the deposit, because the market knows that they're going to be able to rinse, wash, and repeat. Most of the people who pitch it are people who can only raise enough money to buy a small mine. No mistake. Both big mines and small mines have big risks. So for the most part, the idea that you would take a big risk for a small mine, which makes you small money, is stupid. There are circumstances where known aggregators of assets, say a Ross Beatty, start building a company with a starter kit, with a small deposit, using that as a stepping stone to establish a narrative to get institutional backing to buy a second and a third and a fourth. What you'll see is that 2 or 3 years out, they're buying better assets and they're selling off the assets that they started with. Mostly when I get pitched this bootstrap circumstance, you know, we're going to get in production and we're going to use the cash flow of that production to grow without dilution. And after 15 years, we're going to be BHP. Mostly that's bullshit. Usually in a small company, you don't generate enough free cash flow that you can have management expertise in operation, in construction, in exploration. You have to find a management team that does something well, and you have to pay them for what it is they do. What they usually do well in Vancouver is tell stories.
Right. What I think a large portion of the audience that listens to not only MiningStockEducation, but probably podcasts in general, are people that are looking to make a change in their life. And whether it's through the junior resource sector and making money through investments or taking that step into entrepreneurship. I think fear, however, is something that keeps a lot of people from taking that step. Fear of losing money, fear of failure. Do you have a view on how to overcome fear or how you can overcome fear?
I'm maybe the wrong guy. My life probably would have been better served had I been a bit more fearful.
Okay.
I'm reminded of the biography of Adolf Lundin called No Guts, No Glory, which I just reread for the 6th or 7th time. And what Adolf said is that an entrepreneur has no choice. When he sees an opportunity, not pursuing the opportunity is not an option for that person. I would consider myself to be more cautious now, but I would not describe myself, nor would I describe any investor who I know who's been truly successful, as fearful. I remember Buffett describing investing as a game of baseball with no called strikes. If you don't swing at a bad pitch, it doesn't matter, right? There's no called strikes. So what you do is you wait at the plate, your bat is your money, and you wait for the pitcher to get tired and throw you a fat pitch. But then what Buffett said was, when you find a circumstance where the odds from your point of view are truly in your favor, you go all in. You really, truly pounce. And that's a lesson I learned. I've told you this before in interviews, but in the decade of the 70s, I made a lot of money. I confused a bull market with brains. When that market cracked, I lost all my money and more. I went to having a negative net worth. And the pain of having a negative net worth was extraordinary. And there was a time in the middle part of the decade of the 70s where I wouldn't commit as much as I should have committed, given my understanding of the people involved and the opportunity involved. As that prudence allowed me to become solvent, I again became more aggressive. So I guess that I guess that the relevance of fear has to do with your personal circumstance. Now, Brian, I need to say too, when I was an active stockbroker and money manager, I had some extraordinarily wealthy clients who I stopped allowing to speculate because the emotional trauma of even the volatility in the stocks, never mind the risk, caused them so much distress, and frankly caused me so much distress having to listen to them on the phone. I just said, you know what? Either you're just going to invest with me as opposed to speculate, or you're going to go see a shrink. And I guess it's important for people to understand their own psyche and their own needs. But I also think that fear may be a rational response to laziness. If you aren't willing to do the work to understand how to speculate, if you aren't willing to do the work so that you have a perception of the value of the company that you're investing in, not just the price, then maybe your fears are well-founded. If you come to the conclusion that you're either too lazy or too stupid to speculate, then you should be fearful of your own speculative capabilities.
Right. I agree with that. The Rule Symposium in Boca Raton, Florida is quickly approaching July 7th to 11th. Interested investors can attend both in person or virtually. What can viewers or our viewers expect for this year's conference?
Boy, this is going to sound arrogant. Maybe it is. We've been doing this for about 30 years. We've made it a little bit better each year for 30 years. You make something a little bit better every year for 30 years, it gets pretty damn good. And this conference is really good. Let me tell you why. As you suggest, first of all, you can attend live, which I would prefer because a lot of communication is nonverbal. Or if it's inconvenient to do that, you can attend online. In either case, we're going to give you much more programming than you could absorb in 4 days. So you'll have access to the tapes, the recordings of the conference for a year after them. And to get your money's worth, you're going to need it. We're going to give you 55 hours of programming in 4 days. This could be dense, valuable programming, and you're not going to be able to absorb it. To that end, I've interviewed every single conference exhibitor and speaker. Those interviews are available at the Rule Classroom or at the Rule Investment Media YouTube channel, so that you arrive at the conference, whether you attend live or via live stream, with a better sense of how you're going to allocate your time and your fortune at the conference. That's important to note. Other differences. Everybody out there does global macro, and we do too, but we do it differently. Most people at conferences that do global macro use influencers as speakers, or they use journalists as speakers. I don't do that. I use players. At my conference, the global macro speakers are, in a biblical sense, from the belly of the beast. David Stockman will talk to you about the most important economic circumstance on the planet today, which is the U.S. federal government's debt and deficit. A player? Absolutely. He ran the Office of Management and Budget, the first Department of Government Efficiency, back in 1980, and wrote a book about how the politics of Washington derailed the Reagan Revolution within 6 months of inauguration. He'll talk about the Department of Government Efficiency in terms of what it is, which is a fraud. We have Nomi Prinz talking about the corrupt nature of Wall Street. How would she know? Because she was a partner at Goldman Sachs. We have Daniela DiMartino Booth talking about the Fed, not as a failed journalist from some pinko university, but rather as a researcher for the Dallas Fed. We have Jim Rickards talking about the intersection of Wall Street and Washington. How would he know? General Counsel of Long-Term Capital Management, whose failure almost brought down Wall Street. So after we're done with this global macro in a way that you wouldn't get from CBC or CNBC, We go to portfolio construction. We have portfolio managers who've been making money in natural resources and precious metals portfolios for 40 years. Not second-rate analysts from third-rate Wall Street firms who used to do technology and then did crypto and then flunked out of pot, but rather people who have been in the natural resource business for most of my adult life. But it gets better. We have something called the Living Legends, which is my favorite part of the conference. Entrepreneurs who have built multi-billion-dollar oil and gas and mining companies from scratch, talking about how they did it, talking about how the process makes them better investors, talking about what they're investing in today, and importantly, telling you how to identify the $20 million market cap that could become a $2 billion market cap. Another feature, every single public company exhibitor at the conference is owned in the conference sponsors' accounts. They are all vetted. At most conferences, Brian, the qualification to be an exhibitor is a pulse and a check that cashes in reverse order of importance. We refuse more exhibitors than we accept at our conference. That conjunction of circumstance allows me to make an extraordinary offer that I've never seen at a different investment conference in my life. If you attend live or live stream and don't believe that you got your money's worth, no questions asked, I'll return your money. Mercifully, in 30 years of making that offer, I've had to refund about 0.1% of the tuition charged. But that guarantee, full satisfaction or money back, is your guarantee that we're completely confident in the value of the content that we're going to deliver.
That's excellent. Rick, as always, it was great talking with you.
Well, I look forward to hosting you live or via live stream at the greatest natural resource investment symposium on the planet.
Excellent. Well, good luck with this year with it, and we'll talk soon.
Thank you.